It's official. The global economy is on the road to recovery.
The global economy is turning the corner of the Great Recession.
In its latest forecast on April 8th, the International Monetary Fund said global growth is expected to be 3.6% this year, with the U.S. economy forecast to grow 2.8%. But what does this mean for the world of commodities? At the FT Global Commodities Summit here in Lausanne, Switzerland, some of the most influential people in the industry gathered to discuss the biggest issues and trends shaping the natural resources market in 2014. One of the key topics on the agenda was how a slowdown in emerging markets and economic recovery in developed countries will affect the supply and the prices of commodities this year.
It's very favorable that the commodity environment is improving a bit thanks to the growth in the developed economies. We had a super cycle that was very much driven by the emerging markets, and now we've had several years of Fed intervention and central bank intervention more globally. So we've got a very stable marketplace. Some commodities we think will outperform others. We believe that the energy complex is going to be relatively range-bound, both in terms of Brent as well as in natural gas. We're quite excited about the long-term future of some of the base metals, including copper and aluminium. And we're a little bit reserved around the gold market for reasons you'd understand, because as economic recovery it works its way through the system and interest rates start to rise again, gold tends to be an underbid, and we've got a relatively bearish short-term prediction on gold and a long-term price that's roughly where gold is today.
The industry is paying close attention to the economic slowdown in China and the impact that will have on the country's appetite for natural resources. China accounts for about 40% of the world's copper consumption, and prices of commodities particularly linked to Chinese growth, including copper and iron ore, have come under pressure recently.
I think it's important that we look at two pictures here. We've got the metals, industrial metals and bulk commodities. I think they're very, very dependent on China. China is still the biggest buyer of these products. They buy between 40 and 60% of it. So whether China slows down below 7% or keeps above 7%, whether other stimulus comes in, that will really dictate where those prices go over the next 6 months, over the next year. If we flip it over and look at oil, it's a completely different picture. China is only just overtaken the US as the biggest importer of oil in the world. So therefore, it's not as big a demand side of the equation as it is in base metals. Oil, I think that will be a dull market again this year. There's not going to be a lot of volatility, barring a big geopolitical shock. Obviously, we can't rule that out given what we're seeing in the Ukraine and with Russia.
The oil and gas market is also being affected by the shale gas boom in the US.
Gasoline demand, petrol demand in the US is finally stabilizing after years of decline since the financial crisis. That arguably should lead to a big increase, or an increase in fuel prices in the US, but it's been offset to a large degree by just huge increases in oil supply in the US from places like North Dakota and Texas. Gas production continues to grow thanks to drilling in shale formations, outpacing expectations from just a few years ago.
Industry experts say that even a nascent recovery in developed economies will contribute to maintaining a relatively stable environment for commodities in 2014.
We've now got developed economies that are very stable. We've got the shale gas revolution in the United States, which has a huge impact on the manufacturing economy in the U.S. and just the growth in the U.S. more generally. There's a lot of stability in the system. There's a benign interest rate environment. There's a tremendous amount of liquidity. And I think overall it's a good background for commodities. But we are in a period of consolidation where companies in the energy sector, in the mining sector, in the fertilizer space, for example, all are now rethinking the allocation of capital between the company itself and between the stakeholders. Generally speaking, the companies are much healthier, and the commodity environment, I think, will be relatively stable for the foreseeable future.
But that stability partly depends on how the crisis in Ukraine develops and the extent to which China's economy slows. Vanessa Kortekaas, Financial Times, Lausanne.